Hi, welcome to the Fall 2025 It's Your Money and It's Your Estate workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Let's start the program. This webinar is the 5th session of the It's Your Estate workshop series. The topic for today is tax advantages for philanthropy. Our moderator is Peter Kote, and our guest speaker is Lindsey Jacobs. Enjoy the workshop.
Welcome to Financial and Estate Literacy. This is It's Your Estate, and we are in, I believe, our 5th session, and we're going to talk about a very interesting topic today because I love our presenter, Lindsey. Why don't we come on board?
And I'm going to go away and watch the Q&A.
Okay. Lindsey, normally when we have a presenter on, we go through their Ask First form. I'm not going to do that, and one of the reasons is that you work 100% of your time for Chapman University.
Correct.
And so in the field of fundraising generally, are fundraisers allowed to work on commission or to receive monies other than from their employer?
They shouldn't, and I don't. Yes, I have my salary. I'm not for hire for anyone from the series. I'm happy to help them with gift illustrations, which we'll go over a little later in my presentation. But no, not for hire, just here to share some tools and tricks.
And in your particular field, I believe it's called more legacy planning or planned giving.
Yep.
How long have you been doing this?
I have been in legacy planning for more than 11 years. I have a certified specialist in planned giving designation, which means I not only have taken the classes to understand these gifts, but I also have to keep up with current education in order to maintain that status.
Yeah. And so it's a specialized area.
Mm-hmm.
And why don't you bring up your program because I love your title and maybe you can explain that a little bit better.
Yeah. All right. So tax advantages for philanthropy, the secrets your advisors rarely tell you, because sometimes professional advisors just don't know about these. And sometimes some of what we're going to talk about might take things out of their portfolio, so they just may not recommend it. I'd like to think it's a lack of knowledge rather than hoarding, but who knows?
Yeah. So what everybody's going to learn today is probably most advisors do not know, and but the hope is that when you learn some of these things, you'll pass that on to other individuals so that they can explore for themselves some of the benefits of philanthropy that are,
Absolutely.
we call it tax wise, and that's the way we want to be. Because if you're philanthropic, which is wonderful, but if we can make it more beneficial for you, this is what we would like for you to have as well. So maybe encourage others to even give more. Lindsey, why don't we start the program? And I'm going to kind of sign off and I'll be in the background listening.
All right. I mean, that's the first time I've had that with Pete. So this is going to be a different experience than I'm used to.
It is. It's going to be new.
So jumping in, I always like to start by reminding people it's important to know your tax bracket as you're making plans, philanthropic or otherwise. I'm not going to dive into this too much. These are the tax brackets. It's a reminder that you need to know this and that you should be talking with your advisors before tax season about what you might need to do to offset with perhaps charitable giving or any of the topics that we are going to discuss today, rather than getting to tax season and realizing that that would have been beneficial. More on taxes, again, just a thing to be aware of. The estate tax exemption is currently almost $14 million per person. So for a married couple, it's almost 28. And frankly, if you are having estate tax issues, any of the charities who sponsor this would love to take you to lunch to discuss how we can be helpful. The estate tax rate is 40%. That's important to note because that's pretty high. So if you are going to owe estate taxes on what is over that exemption, it's going to be a lot. There's something called a gift tax annual exclusion. That is not charitable giving. That is person to person. So if you would like to give from you to however many individuals you would like, up to $19,000, you do not have to report that on your taxes. Any dollar amount over that just takes off of that estate tax exemption. So this can be a way, like I know my grandfather every year would send grandchildren some money that was under the gift tax exclusion, and we were always grateful. And it did lower the amount of his estate, which mattered for him in the long run because we didn't have an exemption this big when he passed away. It's also good to know what your long-term capital gains and qualified dividends taxes, just knowing these things. And if you're not sure for yourself, again, your advisor should be able to tell you more. Additional taxes to keep in mind, Medicare, you can go online to find your cost. And California's top tax rate is currently 13.3% for an income above $1 million. So it's just additional taxes to be aware of as you are planning. Oh goodness, sorry. My computer did a weird thing. Secure Acts. These changed quite a bit around retirement, so I always like to go back and talk about them. The first one became effective in January of 2020. The second one became effective in January of 2023. The required minimum distribution for an IRA, an individual retirement account, increased from age 70 and a half to 72 in 2020 and became 73 in 2022. It will increase again to 75 in 2033. So that's just when you have to start taking those required minimum distributions. The Secure Act also eliminated the stretch IRA. So when, and this is not for spouses, this is for inherited like children or such. They used to be able to stretch it out over their lifetime if they were financially savvy. And now it has to distribute within 10 years, meaning that this could become a very taxable asset. And we'll talk about ways you can be philanthropic and take care of your family using your individual retirement account. The Secure Act 2.0 created the option of an IRA rollover, also known as a qualified charitable distribution, to create a charitable gift annuity. And I'm going to go into that in more detail, so I promise I'm not just touching on that and leaving. I do have a slide. Right now, one time ever in your life, you may create a distribution of up to $54,000 directly from your IRA to a charity to create a gift annuity. It can fulfill part of your RMD, all of your RMD. It depends on what your RMD is. And it provides a lifetime income stream. That 54,000 gets, indexed to inflation. So every year it changes just a little bit. Again, that's once in your lifetime. And I'll come back to it, I promise. It's so odd to be here without Pete talking with me. So
I'm listening, Lindsey.
I know. I just enjoy you so much. So OBA obviously made a lot of changes. And so I'm not a tax advisor, I'm not an estate attorney, so I can't go into too much depth about those tax changes because that is not necessarily my area. And I hope you are going to your advisor and asking how OBA has affected you, whether positively or otherwise. But these are just some of the ways that changes have been made through the One Big Beautiful Act, Bill Act, sorry. And here are some more. So again, there were a lot of changes. It's important to check in with your advisors regularly just to make sure that you are taking advantage of what is available to you and planning ahead for your taxes. So what are some of the charitable partner solutions in tax planning? You can avoid capital gains taxes. You can receive a current income tax deduction. You can get an income for the life of one or more individuals. There's a couple different ways to do that. You can reduce your taxable estate. Again, if that's an issue, we'd all love to take you to lunch. You can transfer wealth to your family. I know for many people, taking care of family, friends, loved ones is a very important part of them planning and future savings on income taxes. So, charitable giving. A lot of people go with cash or credit card or a check. That's great. We love it. All charities are going to accept it. There are some ways that can be a little more tax savvy. For example, long-term appreciated securities. You still get the same charitable deduction, but you get the savings on not having those capital gains taxes because the charity is going to sell the stock and we don't pay taxes. So that's something to keep in mind as you're getting ready to maybe write a check. Think about if you have appreciated stock, and that might be a really great way to be philanthropic. There's private business interests, real estate, cryptocurrency, gifts in kind, life insurance policy. You can give through your retirement account. We're going to talk about a lot of interesting ways to give. One that I especially am a fan of is a donor advised fund. It's a flexible giving option. So it's kind of like having your own foundation, but no setup cost and the operating fees are lower. And it can be funded with as little as $5,000, maybe less, depending on where you have your donor advised fund. And that could be at like a Fidelity, a Schwab, so many options. So donor advised funds, you make a gift to the DAF, you get an immediate income tax deduction for that gift, and then you can give out that money over a number of years. So for some, this makes sense if you take the standard deduction, you don't always itemize, but maybe 1 year you get a bonus or something, you could create a DAF to offset that additional income and then give charitably over the next few years. So giving that larger amount in that year, and then you take the tax deduction. There's a 5-year carry forward. So if you don't need all of that deduction that year, you have an additional 5 years to use it. And then on your own, when you're ready, you advise your DAF administrator, possibly the Orange County Community Foundation, on how much you want to send to which organization. The reason it's called a donor advised fund, which makes it sound like you don't have the final say, you do. It's just they are overseeing to make sure you're actually giving to a charity, because there are some organizations that present as charities that aren't. So they're making sure you're really giving to a 501c3. So they wouldn't say no unless it's not actually a charity. So another thing I love about these is that it helps to create a philanthropic culture within the family. It's a great way, maybe each year, the kids get to pick a charity. You can leave your donor advised fund to your children to carry on your legacy of philanthropy. You can also, if they don't want to take it on or you don't have anyone to leave it to, you can name charities to receive the remainder after your lifetime. So donor advised funds, pretty neat. So just again, tools for the toolbox. You can give during your lifetime with your IRA. So the Secure Act did not change the minimum age for this, even though it changed the RMD age. So starting at 70 and a half, and if you have an individual retirement account, you can start making gifts that go directly from that IRA to a charity. You can't accept the money and then give it because then that becomes your income. But if it goes directly to the charity, which means either you send it to us or you have them cut a check and they put Chapman University in the title, as long as we're the ones receiving it, then you can still hand over your check, go to lunch, whatever you want to do. But it skips that income. So you don't get a charitable deduction, but for a lot of people, not having that income can be more tax-wise. You can do that up to $108,000 total, so you can do it to multiple charities. It can help fulfill some, possibly even all of your RMD. This is called a qualified charitable distribution or the IRA charitable rollover. And you get to help support the mission of an organization that's important to you. We want you to be giving based on mission, right? So that's just something to be aware of. Pete, you got something for me?
Yeah, I got a question for you. Is it better to give out of your IRA account if you're 73 versus your regular out of your regular income?
That is a great question for your tax advisor, because it really depends on how things are going to fall out. I would say that for a number of people that I work with, and again, I don't know your personal situation, for them not having that additional income on their, taxes is more beneficial than getting the deduction and itemizing. So I know I sound like an attorney. It depends, and that's where talking to your
I
advisor
think
is
it's
helpful.
that way for most of us because the standard deduction is so high, so that our itemized deductions have to uh, be somewhere around 20 or 30,000 in order for your charitable donation to be deductible. So I would say that you would want to donate
Oh,
from your
sorry.
IRA first, look at that, and then second out of the rest of your investable assets.
hmm And to be clear, you don't have to do the full 108,000. That's just what it is this year.
Can
And
you
that
do a
also,
minute? Is there a minimum, or that depends on the institution if they'll process it? You could do $100, for example, out of your IRA.
absolutely.
Yeah.
Yep. You could do $5. I mean, for us, it's a gift, and I don't know any institutions that won't accept a gift.
Yeah, that's good.
Um, you
Good
know.
point.
So another thing you can do, you can donate your life insurance. You can either donate an existing policy that you don't need anymore, and then there are two ways to do that. You either name the nonprofit as a beneficiary for after your lifetime, or you could transfer the ownership to the nonprofit, and then you get a tax deduction for the cash surrender value. You could do a new policy, and again, you can either just name us as a beneficiary, or you can name us as an owner and beneficiary. And if you do that, then when you make a gift to cover the premium payments every year, that does become a charitable deduction. So just something to know that life insurance, not everybody thinks about it, but it can be a great way to be philanthropic. The most common thing that folks do when they are creating a legacy gift for after their lifetime is they include the charity in their will or living trust. I'm sure you've gone over this. In California, most likely a living trust is going to be an important thing to have. And you just write them in for either a percentage or a dollar amount. the money comes to charity. We do what you ask us to do with it. It could reduce the value of your estate, potentially saving estate taxes. I do like to remind people that, life happens, things change, and any specific dollar amounts listed are come out of your trust or will first. So if you just want to be careful, percentages are often a great way to go. Again, this is based on talk with your advisors. And, if you end up living through all of your money, 10% of zero is zero, and then you're not on the hook for a dollar amount that you've put into legal paperwork. So just something to keep in mind. I like percentages, but that's me personally. I'm not your advisor. You can donate your retirement assets after your lifetime. That's a simple beneficiary designation form. It doesn't require an attorney. Usually these days you can fill it out online. You can name us as a beneficiary of stock, of a bank account, again, life insurance policies, pre-tax assets, so like your IRA, a 401k, a 403b, saving bonds, commercial annuity, which is different from the charitable gift annuity that we're going to talk about. The nice thing about this is charities don't pay taxes. So if these are pre-tax assets, we're going to be able to take that in and use the full amount, whereas heirs may pay more taxes. And so I've got a slide on that coming up. So this is just an example. Obviously, this is not for you specifically, but it is an example that somebody with a $2.5 million estate, so they've got a $1.5 million IRA, a $1 million house. If you give the larger asset to the kids, which you're thinking, oh, I want to take care of my children, totally understandable. And then they get taxed. I used maximum tax to show how big it can be. Obviously, not everyone's paying the maximum tax. The remainder is less than $1 million. And if the charity got the house, we still get the $1 million of the house. Whereas if you flip it, the 1.5 million IRA to the charity, we get that. There's no taxes. $1 million house to the kids, they get the step up in basis, no taxes, and they get $1 million. Now, it doesn't have to be the full amount. Obviously, you can do a percentage of the IRA. This is just a slide, for example, not telling you exactly how to make your plans. So this is a fun one. I love charitable gift annuities. I think they're so interesting. You make a gift during your lifetime. It's a simple agreement, maybe 3 pages, no lawyers or fees. It's an agreement between you and the charity. It is irrevocable, so you have to be sure you want to do this because once we receive the monies and sign the paperwork, there's no changing it. Your rate for your gift annuity, which is the income you're going to get back for, again, the rest of your life, or you and your spouse, or maybe you make it for a friend. There are lots of ways to do it, but the rate you get back is based on age. And that is created by the American Council on Gift Annuities. And most charities use those rates because we're not trying to compete on rate, we're trying to compete on mission. You get an immediate income tax deduction. You get a secure lifetime income stream. A portion of that income stream is tax exempt. And then after your lifetime, the charity gets whatever remains in your gift annuity to support the mission. So I have an illustration, or I have the gift annuity rates, then I have an illustration. Again, they're set up by the ACGA. The current rates became effective January 1st of 2024. And if you look at these are some pretty good rates. If you're 80, you're getting guaranteed 8.1% back every year for the rest of your life. These are one life gift annuity rates for an immediate charitable gift annuity. It is important to note that if there are 2 lives, the rate will be a little lower. And actually, that's the illustration I have. So I was very, individual. Larry and Laura Sample are our folks for the example. They're both 76. Again, because there's 2 lives, it's a lower rate. It's a 6.4% income back to them rate. So they gave $50,000 which gives them $3,200 for the rest of both lives. So if one spouse passes away, the next spouse continues to receive it. They got an income tax deduction of just over $16,000. The reason it's not for the full amount that was given is because you're getting some income back. But the tax-free amount of that income, so the amount you're not paying taxes on, is just over $2,000. So really, you're only paying income on about a third of what you're receiving. They chose quarterly payments. You can do monthly, you can do semi-annually, you can do once a year. It's really whatever is best for you. Usually, the charity gets about half after someone's lifetime. So this is an example. And when I talk about gift illustrations, that is something I can do for you personally. It is an offer. Many of the charities can have the software to do this, and I'm happy if any of these gifts sound interesting to you and you just want to know what that could look like for you personally with no obligation that it has to come to Chapman or to create it at all. I'm happy to run this for you so that you can see how it might affect you. So this is
Lindsey,
yeah.
Lindsey, do me a favor, back up one.
Uh-huh.
When Lindsey was talking about, for instance, an 80-year-old, it's something like 8.1%. And in this particular case, it winds up being joint life. So it's 6.4. You can't, that's not negotiable. It's set by the association. And so they want to go through and do that. So that's not an issue. It's a matter of your age at the time. There's something important here, however. That's the rate that they're getting is 6.4. I'm pointing at it on my screen, but you can't see it on your screen. 6.4. However, down here at the bottom, it says 9.4%. So the effective after-tax rate for this annuity is 9.4%. It's difficult to get that return on the open market. So the 6.4% may not seem like a big thing, but because so much of it is tax-free, it effectively works out to a 9.4% return, which is darn good. And incidentally, that's assured for the rest of your life, in this case, lives. It will not go up during that time. Doesn't, as your age increases, it stays at the 6.4% at this dollar amount. So it's not necessarily a hedge against inflation, but on the other hand, it's going to continue to return this rate at this dollar amount. So just want to note that.
And I do have folks who create new ones as they get older because their rate goes up when they get older on the new gift annuity. So yes, it's a really, again, I'm a little bit of a geek about legacy planning, so I find gift annuities really fun. This newer option, I was talking about, using that qualified charitable distribution to create a gift annuity. That's what this is. Again, if you're 70 and a half or older, although you may want to wait until at least 73 so that it can fulfill your RMD in some capacity. Once in your lifetime, you can do a qualified charitable distribution straight from your IRA to a charity, create a charitable gift annuity. It can reduce your RMD. It creates an immediate lifetime income stream for you or you and your spouse. This one you cannot do for friends. It has to be you or you and your spouse. And the remainder goes to the charity for use after your lifetime, or you and your spouse. It is important to note that there is not a charitable deduction for this and that the payments are not tax-free because you haven't paid taxes on them yet. So the government will only allow us so many loopholes on paying taxes. But you are getting that amount in increments. So say you have, again, a major bonus or something, and you want to do something to lower those taxes. If you take your IRA and you create this, then you'll get just in increments back. And so those taxes are lower because you're only getting this portion and this portion. So again, I'm happy to create an illustration for anybody who wants to see what that could be like. Again, the older you are, the higher your rate, and you can only do this once in your lifetime. So some strategies with gift annuities. There's an immediate annuity. That's where you make the gift and you start getting payments right away. That's got the current tax deduction, the immediate payment, and that is what you would have to create if you wanted to use your IRA to do it. There's something called a deferred annuity where you get a current tax deduction, but say you don't need the funds yet, but you're planning ahead for retirement or what have you. You say, I'm creating it now, I'm receiving the payment later, which makes it a higher payout rate because you've deferred it. And then you just have something set up for the future. There's also a testamentary annuity. You create this, either you put it in your trust or you say, I want my IRA to go to Chapman to create this gift annuity. You sign all that during your lifetime. After your lifetime, we create it for the person that you want to benefit. It and then obviously, anytime they get that check in the mail, they're going to think of you and smile. And it's a great alternative to lump sums for heirs who maybe aren't as responsible with funds as you would like them to be. Pete, I see that you got something for me.
Well, what are some of the practical aspects of the charitable gift annuity? In other words, you had mentioned that somebody maybe who can't manage money, um, you could do a charitable gift annuity out of your IRA testamentary. Is that correct?
You could, yep.
So if you wanted to say, hey, for the rest of the person's life, they're going to get X amount of income,
Mhm.
and there's no additional cost. Is a charitable gift annuity contract complex?
No, it's about 3 pages, maybe four if you have a really long description in there, but I've never seen that. So yeah, it's a simple contract. It's between you and the charity. It doesn't require an attorney. It's nothing like a commercial annuity in terms of complexity, and it has a charitable aspect to it, which I love.
Yeah. Let's say I just made a ton of money in crypto and
Mhm.
I wanted to lock in my gain. Can I turn my crypto into a charitable gift annuity?
That would depend on the organization and what they accept for charitable gift annuities. I am sure that some would. Chapman doesn't do crypto for gift annuities, but there are lots of charities who have thriving gift annuity programs and they're willing to take a little more risk with the crypto. So it is certainly possible. You would just have to find the right charity that's willing to take that on.
Let's say I bought Amazon stock and I've had it for many, many years and I just don't, but I need more income. Would Chapman, for example, take my Amazon stock and
Sure
turn
would.
that into income?
Yep, we will take appreciated stock. We will take cash, obviously. We don't take real estate, but many places do. They'll create a gift annuity with real estate. So there are options for how you fund it. It's just institution to institution may have different rules for what they'll accept.
Let's say I wanted to make a gift to someone else, an older individual, mom, an aunt, an uncle, and normally I would not be able to take a income tax deduction for that.
No,
Could I give them income for the rest of their life and I take the income tax deduction?
absolutely. Yes.
So that's another kind of a practical way of of using these gift annuities besides the fact of just being philanthropic.
Hmm.
I've seen them be used to make gifts testamentary of to individuals like the gardener who's been doing the lawn for 20 plus years, or for the caregiver, or for a special friend. Is there again, is there a minimum amount that you could do for a gift annuity?
Again, that changes institution to institution. Chapman's minimum is 25,000.
Okay.
Some places are higher, some will be as low as 10. So it really, again, it depends on each organization's rules about what they will accept and
And would
gift
you
minimums.
say that you'd want to do these with a major institution versus a smaller organization? Are
I
you
would,
regulated in any way by the
oh,
state of California?
Yes, we have to file everything with the California Department of Insurance. So gift annuities, especially in California, are very regulated. So a lot of smaller charities maybe don't have a gift annuity program because it is a lot to manage. However, like the Orange County Community Foundation could help with setting up a gift annuity to benefit some of those smaller charities that you want to take care of in your area, because they are a larger institution.
Thank you, Lindsay. I'll
Yeah.
disappear.
Oh,
I'll come back in. I'll come back in.
great.
If I'm doing testamentary and I am naming my gardener, whoever it happens to be, my kids or someone else, what age do you use to calculate the percentage?
It is the age of the person receiving the gift
At the
annuity.
time I write the agreement with you or at the time I die?
That is an excellent question. I can't remember off the top of my head. Pete, do
That's
you
a
know
good
the
answer.
answer to
That's a
that?
legal answer. It
Don,
depends.
could you repeat your question?
Yes. My question is, I want to do this in a testamentary manner. So I want to give the gardener, my kids, whatever it happens to be. What age is used to set the percentage? I don't honestly today know when I'm going to die. So I
It's
can't see the gardener will be 38 or 75, whatever it is.
the gift annuity will be issued at the time of your death to that particular individual. So it would be at the time of your death based on the age of the recipient annuitant.
That would
That's
have
an
been my
excellent answer.
assumption, but since I was not entirely sure, I don't like to give
Yeah.
answers that I'm not 100% on.
And
And now
since
I
we're
know for
talking
next time.
and since we're talking about this, a question has come in. If your RMD/QCD is less than 54,000, can you make two separate contributions over different years, or is this a one-time only for the gift annuity?
It's a
One
one-time
time only.
only. Yeah.
That's I and incidentally, if you have the money in your account, we say offsetting your RMD, you aren't restricted at your RMD level. So
No,
if your RMD was 25,000, but you had a lot of money in the account, you could still do 54,000 as a
absolutely.
contribution because a lot of us don't get $108,000 in terms of I don't know, in terms of our required minimum distribution, but that's the limit you can go to. And incidentally, I want to note, if you live on the money in your IRA, don't feel that, wait a minute, I need to do this. So that's a whole nother story of just because you can't automatically say, I need the money, I can't do an RMD, I'm living on that much. So that's another point. So
Yeah.
okay, I'll disappear.
Thanks, Don. Thanks, Pete. Um, so moving on. So something, it's going to sound very similar to a charitable gift annuity, and it is, but it's a little different. It's called a charitable remainder trust, and this can be a way to defer capital gains. It does require an attorney, and I strongly recommend getting an attorney who specifically works with charitable remainder trusts, because if the language is off a little bit, it can mess with it. So make sure you find an attorney who knows what they're doing with these. The attorney drafts an agreement. You get to determine your optimal payout rate. So unlike with a gift annuity where it's based on your age, you get to choose your rate. You get an immediate tax deduction. You get to choose if the trust pays a lifetime or a term of variable or fixed income to multiple donors. So it's far more flexible than a gift annuity. A unitrust is a variable amount, meaning that every year it gets valued and they say, okay, your percent based on the value is this. An annuity trust is based on what amount was it when you created it. So, it's whether with a unit trust, it could go up or down. Annuity trust will say the same. So it's really what is your comfort level? The remainder of the trust can be a significant gift to one or more charitable organizations. So with a gift annuity, it's really kind of just that charity. With a remainder trust, you could benefit more than one. And if you if you need if you don't need the full deduction that year, this also has a carry forward. So here's an example. A property bought at $250,000 is now $1 million. in California, that is not unheard of. Um, and in this one, they chose a 7% unit trust. So they put that $1 million property into the remainder trust. It sells without paying capital gains because it's inside a charitable trust. So it's treated like a charity. So you bypass that $750,000 gain in that year. You get an income tax deduction of $371,000. With this one, I made the assumption that it was a rental property. And so, I assumed that they were getting $40,000 in rent and now they're getting $70,000 a year. So that's an income increase. The estimated income would be for about 1.5. So they're going to get back more than they put in because it gets invested, and as it grows, it can be a really neat tool. And then Chapman gets the remainder, which is estimated at 1.2 million. Obviously, this is based on the market. It's not a guarantee. Yes, Pete.
You know, it's the illustration is wonderful, but we've seen this many individuals who have property and they get hung up in age and they don't want to be landlords any longer, but they don't want to lose the income from that property. And so the only thing you have available sometimes is maybe a 1031 exchange, but in a 1031 exchange, you still have property. And so individuals, I encourage individuals to run an illustration to see what some of the benefits are. Just, let's say the value of the property is 1 million, but the only thing you want to give to the charity is what you would have to pay in taxes. Can
Mhm.
you do that kind of illustration?
Sure. Yeah. We can figure out how you have zero taxes. So a portion goes into the remainder trust, a portion goes to you. You don't pay taxes. We can also, if you say, I need $500,000 right now, and then I want to split it up, you can do a partial sale unit trust. Like I said, this is much more flexible than a gift annuity, and it does require an attorney.
Yeah. And so you would probably recommend a charitable remainder trust for someone who's maybe looking at making a highly appreciated asset that's valued somewhere maybe around 500,000, 300,000 and above, maybe, but definitely 500,000
Probably.
and above.
Yeah, a larger asset, and definitely appreciated assets are wonderful for remainder trusts. I mean, you can create them with just writing a check if you want, but avoiding paying those capital gains in that moment and then just paying them out bit by bit as you get your income over your life, is just a really beneficial way to do that.
Yeah. And you can even include children in this as well, can you
Mhm.
not?
It could be your lifetime and then your children's lifetimes, and then it goes to the charity.
Okay.
Yep.
Lindsay, you got both of us now.
I love it.
There's a question that just came in. Do the payouts have to go to the donor or can they go to a different beneficiary? Can a different beneficiary be named? I want to first make a point. The donor doesn't get the money because the donor has to die for anybody to get it. So the donor is not going to be a beneficiary, but they may have their family members or other people. If they give money, if they list a beneficiary, an individual beneficiary who is not a family member, is that an estate gift tax problem?
So the donor who creates the remainder trust can receive the payments. It's because it's
I'm
during
sorry,
their
they receive
lifetime.
the payments during their life. That is
Right, the
correct.
payments, but they don't get an after lifetime beneficiary.
Beneficiary side. Can they
It
give
is,
can they give that money to someone else during their life?
sure. Yeah, you
Have
could
they
name
created
someone
a
else
gift?
as the
Income
beneficiary of the
beneficiary?
payments. It is possible to name individuals as the remainder beneficiaries, but you do have to have a certain portion that goes to the charity. Otherwise, it doesn't become a charitable trust, and then you lose out on all those tax savings.
I will differ with you. I believe the remainder has to go to charity. You can
Yeah,
name different charities.
that's what she's saying, that there has to be a portion going to charity.
And okay, we have a semantics issue. Um,
Mm.
okay, thank you.
Sure. So this is called a charitable lead trust. It's basically the opposite of the remainder trust. It's a way to take a wonderful asset and pass it to heirs without paying extra taxes, without paying too many taxes. There are obviously taxes involved. Again, an attorney drafts the agreement. You contribute whatever that is. Maybe it's a property, maybe it's a certain stock. You put it in that charitable trust. You say the charity gets the payments. So they're the payment recipient for a certain term of years. So this isn't based on a life, this is a term of years. After that term of years, it the remainder of what's in there, the property, whatever it is, goes back to the heirs, and you've gone around the estate taxes. So you do receive a tax deduction at the time of your gift. After the period of time, it goes back to family with the additional growth. So this is an example. It's a property of $10 million. They want to pass it along to their heirs, but if they do it through their estate plan, it's going to get up into estate tax territory. So it goes into the trust, term of years. The charity gets $500,000 a year, total of $10 million. We are thrilled. Thank you so much. We'd like to name things after you, and thank you profusely. You get a charitable gift tax deduction of more than $6 million. After the term of years, the trust goes back to the family. We're assuming a growth of up, it became $30 million. Again, we'll see, but that is what the software ran. So they get that whole property without paying the estate taxes on it. We don't see many of these because they are obviously not everybody has a $10 million property, and it exists. So everything I'm talking about, I'm not saying you have to. I'm saying it's good to know that it's a possibility.
It's also because so few people know about it. So few advisors are familiar with these types of plans. And because as soon as you say philanthropy, everybody thinks of I'm giving my money away, and not the aspect of the potential income over many years that can come from this. And Congress encourages people to do these kinds of plans because it's a more effective way of getting taxes to the community. And so the hope is, when you hear some of this stuff, that you pass it on. It's a good cocktail conversation that you can literally make money. And sometimes it's the best strategy to use charity and philanthropy to make a financial decision.
Yep. Yep. So some additional options that I always like to remind people exist. You can live in your home and get a charitable deduction. So it's called a retained life estate. You give your home to the charity, but you live in it during your lifetime. And there's an agreement set up for who pays for which, property maintenance, etc. You receive an immediate income tax deduction. Then you can also, again, you get that 5-year carry forward. So if you don't need that full deduction that year, you got 5 extra years to take it. There are some charities that will even do this, perhaps as like a gift annuity and a retained life estate. They are more rare because obviously you're fronting the cost, but it is a possibility. I want to say, I think Pepperdine does it, but don't quote me on that. So again, this is just something to know about retained life estate. Another option is a bargain sale. So you need some income from the sale, but you also want to offset some of your taxes. So you sell your property to the charity at a discount. Let's say it's worth $500,000 and you sell it for $250,000. So you get $250,000 and you get a charitable deduction for that other $250,000 that you didn't charge the charity. You can, again, there's that 5-year carry forward. You have the year of the gift and the next 5 years to use that full deduction. So it's just, there's some interesting stuff that you can do with charities to plan ahead. I always like to talk about what is the value of a legacy gift. Obviously, it is the ultimate gift. It's the last gift. It's usually the largest gift from an individual to support the mission of the nonprofit that they love. We hope as nonprofits that you will discuss with us for a few reasons. One, we want to talk about which assets are the best assets. Again, who gets what matters. We want to record your plan. We want to know what you want us to do with those funds because we want to honor that. If we get a random $1 million and we didn't know about it and all it says is Chapman University, we're grateful. We're clearly going to use it for our mission. But if you had really wanted that to be scholarships and it doesn't specify that, then unfortunately, we're not honoring your legacy the way we want to because we didn't know. So the hope is you'll talk with the nonprofit, you'll tell them what you want them to do with it. You'll discuss whether you want it to be immediately used or create an endowment. An endowment is a permanent fund that gives off a portion every year and just continues on. If naming opportunities are something that you'd like to discuss, that's something to do during your lifetime with the charity. And it doesn't have to be your name, although it certainly could be. I have a number of folks who want to use just like they'll create the, say, Jacob's Family Endowment, or they'll name it after their parents. So if naming is in some way important to you, that's a thing you need to discuss with the charity during your lifetime. The biggest thing is we want to say thank you. Thank you, thank you, thank you, thank you. These are such incredible gifts, and the best part of my job is telling people how much I appreciate them. It really is so much fun. So your call to action is consider your legacy, what's important to you, notify the nonprofit of your gift intentions, your interests. Again, you can engage in the conversation. It doesn't obligate you to make the gift. You're just finding out what's possible and discussing what you might want to do. Explore your options, ask for gift illustrations. Again, I'm happy to do that. Allow us to thank you. I can't say it enough. We love doing that. Discuss with your trusted advisors before you make any of these, your CPA, your wealth manager, your estate attorney. I have tools I can tell you about. They're going to know which tools work for you. And the hope is, and while this can be a little uncomfortable, share your plan with others because it really could inspire them. I'm not saying you have to tell them dollar amounts or anything, but even just saying, hey, I put Chapman in my trust, or hey, I made Chapman a beneficiary of my retirement account, could inspire someone who knows you to go, oh, if you can do it, I can do it. Because, I can talk all day long, but I'm not your peer necessarily. And peer-to-peer inspiration is really what it's all about in philanthropy. So I'm at the point where I'm happy to answer questions. This is my contact information. Again, I'm not an attorney, a CPA, a financial advisor, so I can't tell you what you individually, what would be best for you, but I can talk to you about different gift types. Yeah, Pete.
All right. Thank you, Lindsey. We would give you an immense round of applause to get through this technical area, and hopefully we have people who kind of understand it. Don, why don't we go ahead and come on screen and we'll kind of come up with any kind of questions that we may have from the audience. Do we have,
Pete, I think this is a follow-up to a question that you answered, and it says, thanks. The house is theirs upon my death, but I retain title until then.
you
I
retain
don't,
title, you retain title as a life estate. In other words, so it is yours during your life, but upon your death, it goes fully to the charity. It's
Correct.
called a
Yes.
life estate. You're
Okay.
retaining a life estate. So you, you can even, with the charity's permission, you can even sell it. You can do lots of other things if depending on the agreement that you have with the charity. It's a lot more flexible than a reverse mortgage. In a reverse mortgage situation, if you move out of your house and don't move back in, then the house has to be sold. So that's not the case with this kind of a plan using a charity. But again,
Lindsay, why don't you
depends on
stop
the charity.
sharing?
Okay, I was wondering if it was
Yeah,
time.
please. Yeah,
Yeah.
I was gonna say, oh yeah, we do. I think a follow-up question to that is, if with a life estate, can you have a mortgage against the property? No,
No.
because if you die tomorrow, that title has to be clear, and therefore you are not allowed to have a mortgage. And it's one thing to consider in terms of doing a life estate. I think they're a lovely idea. I want to make certain that people understand a couple things. Pete's referring a bit to the fact that you can set up an annuity with it, a charitable gift annuity or something equivalent. That has to have a really large charity. For instance, the American Heart Association will do that only on your second house. They won't do it on your primary residence
Right.
because the issue Pete just alluded to was what happens when I move out of the house? Who's responsible for it then? What's happening? And there have been issues where the charity said, well, you're not there anymore, therefore. And so you need to be very cautious with it and make certain that you're documenting the heck out of it in terms of what's going on. So that's one thing that's a very sensitive one. For instance, do you have the money to pay for your long-term care? That's a part of the situation that you run into. And if the long-term care, as Pete alluded to, you may well be able to sell the property with the agreement of the charity where you get a portion of it because you retain a life estate, which is not the house itself. It is a portion of that, sort of like a gift annuity, where that one stands also. Pete, you're bouncing back and forth this everything. You got any of these?
No, there's a lot of questions regarding the life estate
Yeah.
and can you use art uh, to fund a charitable gift annuity or a charitable remainder trust? Let's say it's a very valuable piece of art.
If the charity is willing to accept art, then yes.
Yeah, it's for a charitable gift annuity that would be a little bit more difficult, but for a charitable remainder trust for a valuable piece of art, the whatever happens in a charitable remainder trust is kind of like an IRA account, and so there's no taxes paid on any kind of a transaction because it's a charity.
Mhm.
And so you can have crypto in there, you can have art in there, you can have a valuable violin in there, any highly appreciated asset. The question is, make sure that you have a certified appraisal and that it really is the value that you're stating it is. So, because that value is going to be your income tax deduction, then once it's sold, then that money gets reinvested and that gives you income for the rest of your life.
And
And
I
not
want to make
every,
sure.
go ahead. I was going to say, not every appraiser can give you a certified appraisal for a charitable remainder trust.
And a
So,
real estate agent is not a certified,
no.
no, appraisal. No, that's their desire of what they are. So I want to point out something very important with what Pete's saying. Two parts of this. One is, can you give art or crypto or any, your coin collection, whatever it happens to be, into these trusts? Yes, you can, but it has to be able to be sold because you're going to get money over your lifetime. And if you hand them your coin collection and it's worth $1 bazillion, that's swell. But if they can't sell it, they can't give you money. I'll give you an example. We had an office building. We put it into a charitable remainder trust. The building then was to be sold, and we would then have the income. Until it's sold, we didn't get income. We got from the renters, that income, but it wasn't the actual amount until the item was sold, because that has to create the money. And it sort of connects back to a couple of questions that are coming in terms of a mortgage. When I put the office building into the trust, it couldn't have a mortgage. If you're doing a life estate, it can't have a mortgage because they have to be clean. If you put a building into in our case, if we put it in, we could have said, okay, this is a split interest. I'm taking money out, which effectively is the value of the mortgage, because I have to pay it off. So I would have paid tax on that portion, not on the entire amount. And that's where a lot of these things you really have to work with someone who understands them, talk to them about it, and it's very, very completely variable, as Lindsey has said, depends on the institution and whether or not. And yes, you want to use a large charity to make sure gift annuity. You want a large one because small ones aren't going to, one, they don't all offer it. And two, here's where we're going. So,
Yeah.
yes, Pete.
Don, by the way, Don is our philanthropic advisor for our financial and estate literacy. And he's done a charitable remainder trust and has named his two daughters as successor advisors on his DAF, Donor Advised Fund.
Because half the remainder goes into a DAF and they will administer that going
Yeah.
forward. So that's the
Yeah.
way we chose to do it.
So, and he has two wonderful daughters, and they are now going to be in charge of giving that monies away later on. So you can be pretty creative with these kinds of tools. And just so you know, I mean, it's actually been borne out by studies that people who give actually live longer.
Mhm.
How many gift annuitants do you have that are over 100, Lindsey?
Uh, Currently, most are in their 90s.
No, well, expect them to live to
Oh,
be
I
over.
do. Oh, I've
Yeah,
been doing this long enough.
yeah.
Yeah.
When we get together with, especially with university folks, and they kind of talk about the population that is over 100, because they're usually gift annuitants. But you actually, you know how stress reduces your lifespan. Eustress is the exact opposite. When you do good things for other people, you actually, they say that on the average that you live 2 years longer. Now, we can't guarantee that, but we find that individuals who give are wonderful. And this, you know, your point, Lindsey, about making yourself known when you make a gift, it's almost a second gift because people have this image that only the super wealthy make gifts. You know, that's not true, right?
No, no, I have gifts ranging from in the $100 million range to 1,000 because for every individual it's something different, and we just treat it as you've called us family, and we say thank you in the exact same way.
Yeah.
I did see a question about how proactive charities are, if they know about a legacy gift, in working with trustees. And I'm going to say it again, it depends, but I will tell you that at Chapman, my colleague David Moore and I, one of us will become the primary contact, and we do reach out to trustees and follow up and say, we know this was the intention. Is this still in the plan? And we work with them directly. We include our legal affairs team as needed to review documents and such. And then it really depends on the charity if there were to be a need to go to court. Some charities will fight for it, some don't feel that that is appropriate. But in general, the charity should at least have like somebody on the legacy team following up with the trustee and working with them to ensure that your legacy happens the way you want it to happen.
A very common occurrence, very common, is that people leave their charitable donations in their trust, and they have a large IRA account.
Yep.
And, you know, use your IRA account to make the charitable gifts, even upon your death. And because the charity, again, doesn't pay income taxes. So, you know, use what we call the bad money for a charity and the good money for your heirs. Do not try to use a Roth IRA, though,
No,
for
give that to the kids.
charitable gifting, because the Roth IRA has already paid the taxes unless you know, you don't have any heirs and you just want to benefit. It would be very philanthropic if you made a gift out of your Roth, but it wouldn't be tax wise if you have a regular IRA. So in making a gift, uh, talk to a specialist like a Lindsey, a Don, myself. That we can help you make the best tax-wise gift, or maybe solve an issue. I mean, I just had a situation where someone had an alcoholic son, and they did not want to give him a lump sum of money out of their IRA account. And so what they did was set up a out of the IRA. It went to a charitable remainder trust. He receives income for the rest of his life. And he was involved in the planning. So he knew kind of what he was going to receive. And the remainder was going to study alcoholism at one of the universities. So sometimes, all these things can really mesh together if your advisors and individuals know what you're trying to do. What goal are you trying to accomplish?
Yeah, I always recommend if you can, please talk to your family about why you've done something charitable so that they're not shocked. And
Surprised?
if you can't have that conversation, for some people that's just deeply uncomfortable, write a letter to them explaining why you chose to make a charitable gift through your estate plan so that they at least have an understanding.
Yeah.
Um,
People equate gifts from your estate as how much you loved them. And so if you give a gift to charity and you exclude them, uh, they may interpret that as something completely different than what you intended.
right.
Not all of our kids are wonderful. There are people in society that just can't make it. And so we have to support them one way or the other. Any last thoughts, Don, before we sign off?
No, but yes, there is actually. And I want to do this only because yesterday when we were doing It's Your Money, there was a book that was referenced, and if someone wanted a copy of it, how are they going to get it? And people had put it into the chat and other things, and that didn't seem to come across to us. So I am putting into the chat right now. There is the address.
Hepner's
So if you
book.
want Mark Hubner's book from yesterday, that's Neil's email address, and copy that down and send it, because as I said, we sort of lost track of all the people who had asked for it.
Are
So
you
I just
putting
wanted to
that?
put that in.
Are you putting that in the chat?
It already is.
Oh, I don't see it.
Do you look at the bottom of your chat?
Yeah,
I
I
just
looked
sent it
at
to
the
everybody.
bottom.
Maybe you're not in everybody.
Yeah, I am. So it's Neil. Let me put it in. Neil at ifa.com.
Now,
And there it
Don, didn't
is.
you have a quiz for people?
You
Yeah,
know?
how to use chat. We did the quiz.
Okay, good.
Yeah.
Uh,
Thank
Pleasure to
you,
mind it's
Lindsey.
there.
Why don't we do the quiz?
Is it there now, Mark? Is
Now
it there
it's
now?
there.
Oh, so you know
Now
what
it's
you
there.
should do for intelligence testing is you should hit enter, and then it goes actually gets sent out.
That's how it works?
That's how it works. I don't do Q&A. I do Q&A. I don't do chats. So anyway,
You
um,
want to do the survey quickly? Just for
did we
curiosity?
do it? I thought we did it at the beginning. We didn't do it?
No.
Oh, shoot. That's what Lindsay was referring to. I thought you were being facetious.
Nope.
Okay. So
I can
here's the
be, but
chat.
not always.
Here's the set. Thank you for asking. Here's a set of questions for you. If you've taken a required minimum distribution, RMD, do you use a charitable QCD? And I don't know what it is. We just talked about that. That's fine. Have you included a charity in your will or trust or estate documents, really, of any form? So if you don't see this, you should be able to see it. I'm looking at my laptop over here, and it is coming up on there. So that's where we are at this point.
We'll give it 30 seconds to see
You'll be at, yeah,
what we
yeah.
get as far as
We're,
answers are
we're
concerned.
building up people over here.
We're
So
trying to make the program a little bit interactive. So hopefully it comes across well. We never know. And the answers are
Everybody
this
include
point,
charity.
let's give it a little bit more time, only because we're a little
Okay.
bit below the number I would like. Incidentally, if you have any comments or anything else in terms of how we're doing, other than not being very professional in the way I run Zoom, we'll do that. So, okay, let's end the poll, and I'm going to share the results.
So if you so we had 30%, 50% said yes, they use a
Oh,
QCD. That's unbelievably high.
good for
Spread the
you all.
word. So for those who said yes, for those who say no, take a look at it, and hopefully we who don't know what it is, uh, hopefully our explanation helped. Have you included a charity in your will or trust? 50% said yes. That was unbelievably high. And 25% said no, not yet, but plan to. So thank you, everybody, for giving us that feedback. That's really nice to hear. And especially nice to hear that so many of you are considering a charitable charity in your plan. There are so many wonderful charities, and if all of us take two or three, try to limit it to five at the most. It has a greater impact on the charities that you do give to. And then just keep your fingers crossed that other people will donate to the other wonderful charities out there. Any last words, Lindsey, before we leave?
I just want to remind folks that I am happy to be a resource, whether it's gift illustrations or questions about these gifts, even if your plan doesn't include Chapman.
All right. Thank you, Lindsey. You're wonderful.
Thanks.
And Don, I wish you were wonderful, but I have to see you again next week.
Well, I'm sorry because Pete's picking on me because I actually have my 70, how old am I? 76th
76.
birthday today. It's
Okay,
not easy to
so
say after the surgery,
happy
cancer
birthday.
surgery. Thank you, Pete.
All right. We'll see everybody next week. And you got a happy birthday.
Thank you very much.
Take care.
Yes, this has been Financial and Estate Literacy. It's your estate. We've been talking about philanthropic giving, and we thank you very much for attending. And we will see you the next week for our last session. Take care. Have a good
It's your
weekend.
estate administration.
It's your estate administration. I wasn't going to give the topic because people don't like that topic.
Okay.
Thank you, Pete. See you next
Thank
week.
you. Bye.